The day we've all been dreading has arrived. After 6 decades at the helm of Berkshire Hathaway, Warren Buffett has announced his retirement. The Oracle of Omaha is leaving Halteman. Warren Buffett has not only been one of the great investors of our time, he has also been a teacher and mentor. Warren Buffett has been known for his financial education and explaining his methods and ways of investing to everyone. How are you? I'm Jordi Sebasti, an investment fund manager, and in this video we're going to analyze 10 of his most powerful teachings. And I'm not going to just skim the surface, I'm also going to give you my perspective as an investment professional who has been running investment funds for 10 years. Let's get started. One of Warren Buffett's most famous rules is this one. Rule number 1, never lose money. Rule number 2, never forget rule number 1. It seems obvious, right? Well, for many people it isn't. Many people who invest money in the stock market always think about what they are going to gain, but they think very little about what they could lose. With this phrase, Warren Buffett reminds us of the importance of preserving capital and the very damaging effect that a very deep loss of capital can have. And this becomes very clear when you do the math. If you have a share that is worth 100 and it falls by 50%, it is worth 50. But what has to happen for this share that is now worth 50 to recover 100? It does not just have to rise by 50%, it has to rise by 100%. Therefore, deep capital losses are very difficult to recover. With this phrase, Warren Buffett implicitly reminds us of the concept of margin of safety. In order to have said margin of safety, when we make valuations, we always tend to do so with conservative estimates. What does this mean? Well, if the market is estimating that the company is going to grow 10% over the next 5 years or that it is going to have a margin, I'm making this up, of 30 over the next few years, then we make the estimates with a growth of 7% and a margin of 25. By doing this, you ensure that if the scenario that the market or that you have as a base does not come true and a worse scenario does, you still have margin and potential for appreciation. Lesson number 2, it is better to buy a wonderful company at a fair price than a fair company at a wonderful price. Warren Buffett, coming from Graham's school, looked for very cheap companies, but after a few years he understood that it was better to buy quality companies that were not so cheap than to buy those companies of lower quality at very low prices. This is the typical saying that sometimes cheap is expensive. Well, on the stock market it also happens that if the business is mediocre, no matter how cheap it is, it will end up being expensive. Many times, investors with a somewhat more value bias tend to buy companies that are very cheap, but what they forget is that these companies are often cheap for a reason. In this type of investment philosophy, the important thing is to see if that reason is something temporary that will pass or, on the contrary, if it is something that is truly important and the market has valued that situation well. This is very difficult to do. Very few investors are capable of allocating the time and have the ability to carry out successful sustained management over time with this philosophy. What happens to many investors who fall into value traps? What is a value trap? Well, it is when a stock falls abruptly, you buy it thinking, wow, this is very cheap. Well, it is very cheap and it will get cheaper. This happens when the reason for the fall is justified. And what if you enter when the stock has already fallen by 50%, thinking that it is not going to fall anymore? So you find that the stock keeps falling, it keeps falling to 80, 90, whatever, and you end up stuck in a stock, well, with a very large drop and a huge loss of capital. There is also another aspect implicit in this phrase, which is that quality companies are always valued at higher multiples. The key with quality companies is to find times when this valuation premium that they normally have is reduced and you can find good quality companies at the prices of normal companies. This usually happens in times of nervousness or in times of economic weakness. Phrase number 3, be fearful when others are greedy and be greedy when others are fearful. This is also one of the most famous phrases and it is also one of the most difficult to apply, especially in extreme market moments. It is very difficult to get out of the market when everything is going up and it is also very difficult to enter the market when everything is falling sharply. It is very difficult and it can also be a big mistake. Imagine that in 2023, when the market was rising, you decide to get out of the market because everything is too expensive. What at first might have been a great success, selling when everything was up and waiting for a correction to re-enter, would end up being a big mistake because you would miss out on the entire rise in the market in 2024 with cash in hand waiting for that correction. There is a very famous quote by Peter Lynch that says that more millions have been lost trying to anticipate a market crash than actually having the market crash in their portfolios. In my personal opinion, market timing is practically impossible to admire. What is more tangible and can be seen is when a rise or fall has gone beyond what it should have been, and that is when one has to make decisions. Quote number 4. The stock market is a great tool for transferring money from impatient investors to patient investors. Warren Buffett reminds us that the stock market always rewards those who are more patient and not investors who make short-term moves. In the long run, all these trading strategies, momentum, etc., are very difficult to maintain over time in a successful way. If the stock markets were that easy, all the people who have taken trading courses would all be driving Ferraris on the street. And that's not happening. The only one who is always happy to make buy and sell transactions is the broker, who is the one who takes a commission for each movement, both entry and exit. They are very happy that people trade. But I'll be very clear, in financial markets there are many things that you cannot control. Political movements, Donald Trump's tweets, whether he imposes tariffs or removes them, geopolitical movements, macroeconomic movements, all of this is beyond the control of an investor. But what you can control is the price at which you buy a share, and this is where the margin of safety and the time frame that you are going to be in the market come into play. The more time passes, the more likely you are to make money. Sentence number 5. If you can't find a way to make money while you sleep, you'll work until you die. With this quote, Warren Buffett reminds us of the importance of having assets. Assets that give us a return. And here I would add a nuance. Assets that give us a return that exceeds inflation. Because if you have cash in an account that gives you 2% and inflation is 5%, then you are losing purchasing power. It is very important to have assets that preserve your capital with respect to inflation. Quote number 6. Our favorite investment period is forever. Warren Buffett reminds us of the importance of investing in stocks with the mentality of an owner. Let's not buy stocks with the mentality of a graph. Let's not buy stocks with the mentality of making money in a short time, but rather buy stocks with the mentality of I am buying this business. This business has people, it has buildings, and it has a path in the future. If we are able to travel this journey with the stock, we will make a lot of money. Here we have the example of Apple. If we had bought Apple shares in 2000, right at the bottom of the correction, and sold them in 2003, for example, then we would have made a lot of money, but if we had held them until today, the money we would have made now is nothing like the money we made in 2003. It is often a big mistake to sell high-quality companies simply because they are at your target price. If we expect a company to continue making more money in 5 years, to continue selling more, and to continue having that strength that protects it against other companies, it is a mistake to sell it because it is at your target price. Surely in 5 years, even if there is a short-term correction, in 5 years that company will still be worth more. Sentence number 7. Diversification is a protection against ignorance. Diversification makes little sense for people who know what they are doing. Warren Buffett is not advocating diversification, but what he is saying is that if you know a business well, you should focus on it. I have my reservations here. There are investors who have very biased and concentrated portfolios where there are ideas with a lot of conviction, and obviously the manager has a lot of knowledge in this regard. What they forget here is that humans can make mistakes. You can have a lot of conviction in an idea, but then it turns out that you are wrong. If you have a lot of weight, both personally and even if you are a professional investor in a mutual fund, that mistake can do irreparable damage to your portfolio or to the portfolios of the clients who are trusting you. On the other hand, we have portfolios with excessive diversification. There are many people who have many positions, even many positions in mutual funds or ETFs. Let's remember that a mutual fund or ETF will have at least 50 or 60 positions within it. Now imagine if you have a portfolio of 30 ETFs with 50 positions each. If there is a stock present in any of these funds or ETFs that goes up 50%, you won't even notice. That's why I advocate for a balance between the two positions. If you are convinced about an idea, you obviously have to overweight it, but you must not forget that you are human and that you can make mistakes. A certain degree of diversification is always necessary. Sentence number 8. Investing is not a game where a guy with a coefficient of 160 beats one with a coefficient of 130. Warren Buffett reminds us that to invest you don't need to be a genius, but you do need to have more emotional control, more patience and more common sense. Every day we have more access to more information, big data, artificial intelligence, and thanks to all these tools, the essence of remembering what we are doing in the financial markets is increasingly being lost. The financial markets give us the opportunity to access companies that if they were not listed we would not be able to invest in. These stocks that we are seeing on the stock market are not numbers that go up and down, but rather companies with buildings, people, machinery, etc. If we want to invest like Warren Buffett, we have to go back to basics, remember where things come from. And where things come from is investing in companies with a philosophy of owning the company. Sentence number 9. The stock market is the only place where people run away when there are sales. And this is a truth as good as day. The stock market is the only place where when something is worth half as much, people sell it instead of buying double. Imagine if that happened in a clothing store where they told you that a pair of pants that were worth 100 are now worth 50 and instead of wanting to buy them you wanted to sell them. Well, this obviously happens on the stock market. When this happens, there is a narrative that a crisis is coming, that they are going to impose tariffs, etc., etc. This is when we see the importance of analysis. If you know what you have in your portfolio, the stocks you like, moments of nervousness and moments of uncertainty, for you, instead of being something negative, are buying opportunities. On the other hand, if you don't know what you have in your portfolio, what you're going to do is get nervous, see that you're losing money in your portfolio, and in order not to lose more, you're going to sell. And the last sentence, sentence number 10, never invest in a business that you don't understand. When investing, we always have to stay within our circle of competence. I'll give you an example. There are many investors who focus on very complicated investment theses. For example, I'm going to invest in a biotech that has 3 molecules to cure cancer. If one of these 3 molecules works, this stock will multiply by 100, and if they don't work, this is worth 0. To analyze this company, if you're not a scientist or a doctor, it's very difficult for you to know where the company is going. On the other hand, if you invest, for example, in Inditex shares and you walk down the street and see that more and more of the brand stores are opening, it is much easier for you to predict the company's growth. Although this may seem like such a logical thing, the financial markets often forget it and investors start investing in companies they don't understand. And when you're in something you don't understand, when the market goes against you, that's when you get nervous and make forced sales. Warren Buffett is retiring, but his teachings will continue to be with us for many years. If there's one thing he's taught me, it's that to invest well, you don't need complicated formulas or endless Excel spreadsheets. Instead, you need to apply common sense and patience to your investments. Let me know in the comments what phrase has left the most impression on you and what you're applying to your investments. I'm curious and want to know. And if this video has given you value, remember to subscribe to the channel and activate the bell. See you in the next video.